So this webinar is all about life after COVID-19, whenever that may be, and whatever that may look like. Obviously, it's quite difficult for us to make predictions, and I don't think that's probably the most helpful thing. But what you kind of see is like the foreseeable challenges and how you're planning at the moment to mitigate against those. So it's really about mobilizing back to a new normal, because it won't be the normal that we had previously. So for the first question, which will be for everyone, I've seen just from reporting across bridging commercial and development finance today, that there are a mix of pessimists and optimists on whether the real estate industry will be able to hit the ground running when this new normality starts. But what do you guys think? Actually, as a lender, Dan, what do you think? Are you a pessimist or an optimist?
I think that there's an element of pessimism at the moment, but I guess in an unpleasant way, I'm actually quite excited about it, because it's a good opportunity to reset the landscape, and there will be new players coming out of this, and undoubtedly some good opportunities. So I'm optimistic for the medium to long term, albeit pessimistic of the short term that we're going through at the moment. But I think what I've been surprised about and somewhat pleased about is a lot of people are still wearing the 2009 t-shirt and have got that experience, and everything seems to have accelerated and happened at breakneck speed this time round. So people have really taken hold of the situation, made tough decisions, reset their businesses, and I think that will position them well for hopefully a relatively quick recovery going forward.
Yeah. Nicola, from a developer perspective, are you optimistic or pessimistic about the new normal?
On one side, I'm quite excited of the opportunities that actually will be coming to this market. Right, we've been doing appraisals of land and sites for the last 5 or 6 years and never come to the value that we actually want to buy them at. So on that side, I am excited that I think the opportunities will now start coming our way, which is great. On the other hand, we are delivering 2 very large schemes, and I think that the difficulties in managing those and getting through this period and seeing what the contractor landscape and the subcontractor landscape is when we get to the other side is incredibly challenging, and I think it's going to add in general cost and time to development, which is going to be very challenging.
Ed, what are you seeing from a broker perspective? Are you seeing, are you optimistic or pessimistic? And also, what about your clients?
Yeah, I mean, I think it's been massively challenging for everyone in the market over the past 6 weeks or month. From a debt advisory perspective, I guess it's just really important for us that we stay at the forefront of the quickly changing market. So ensuring we know exactly who is doing what and how that's changed, to offer our clients the best possible advice.
Mm-hmm.
Yeah, I think I'd add to that. I think, we continue to get inundated with inquiries in this period, and we don't expect that to level off, especially when the market returns. The new normal, what is the new normal? I think is the question. So I guess, taking a sort of stance, we're neither pessimistic nor optimistic at this point. The key is to remain professional, to share experience, as Dan pointed out. Those with their 2009 caps on will have the experience, will be able to navigate the market, will be able to reflect the sentiment of the market to their developers and clients, and give the right advice, whether that be price-based or inquiry-based or specifics-based. It's about delivering advice and being able to give the right product to the right clients. And I think that's key here, and that's what we continue to do to try and give first-class professional advice throughout the market. But at the moment, the inquiries aren't coming off, and we don't expect them to do so. What the new world looks like, I think we're all eager to find out. But we're kind of in the middle at the moment, I guess, on that. Ed, if there's anything that you want to talk about, I don't know.
No, I agree. I agree. I think one of the benefits of having been in the market for so long are having some really close relationships. And what's key for us at the moment are looking after our existing clients and working as closely as possible with our funding partners to ensure we know exactly what their appetite is.
Simon, what are you hopeful for the new normal, whatever that will look like?
I think I'd echo what Dan has said. I think we've got a mixture of clients. Some are very optimistic, seeing some great opportunities coming. Some are more pessimistic and cautious. But I think there's going to be short-term pain, but medium to long-term, I think it might be great guns. And also, you have to remember we've still got Brexit to get through as well. So it's a bit of a perfect storm in a way. So we'll see what happens there.
You still think that Brexit's like something which is at the forefront of people's minds?
It's not, but I think it's been put to the back burner, but it's still there. So it's the elephant. It's still an elephant to come back into the room.
I think it's another layer to having to navigate as well, because we've got this coronavirus scenario and the effect that will leave. But as you quite rightly pointed out, Brexit is still there, and that still does need to be navigated, and that will have its own effect on the market, and whatever that may be, I'm sure we'll be there to find out and manage.
Sure.
It's certainly another threat to market sentiment, and as we know, in all markets, demand is driven by sentiment, and as we get through COVID, and hopefully that will be quicker rather than longer, that will be a hurdle, and I think there will be lag later in the year caused by the Brexit negotiations. Our forecasts, which are produced by our research team for the 5-year period, currently haven't changed. We're predicting in 2024 about 15% growth. What we are saying, though, is that the shape of that growth will be pushed further back. But going back to the point, Brexit cannot be ignored.
Why has the growth not changed from Savills' perspective?
I think fundamentally we started the beginning of this year and the back end of last year with a Brexit bounce and a Boris bounce. The statistics for this year were quite encouraging. Over £1 million within central London, there were 328 exchange deals, which was quite phenomenal, and that was probably about 30% up on last year. So that was exceedingly encouraging. So within the market, my belief is that there is pent-up demand, and yes, we do have a big challenge at the moment to get through, but that pent-up demand isn't going to disappear, although within that will be one or two sectors that won't survive and others that will be seriously impacted.
And this one's for Matt and Ed. How do you think the huge shifts in the way of working life introduced as part of the fight against COVID-19? How will this dramatically change the way the industry works in the future, and what do you think the new normal will look like?
I think, again, commenting from a company perspective, to start off, we're generally built around being quite inclusive, working as a team, sharing experiences, advice, underwriting in-house, etc. So from a company perspective, it won't necessarily change the way we approach our business. But going wider, talking about a structure, so tech, the involvement of tech may fundamentally change the way some businesses work. We've proved that remote working is relatively successful. once the creases have been ironed out, you know, this experience or exercise or period, as you may call it, may bring that forward. You know, the inclusion of tech is always going to come. We know that, but that may be brought forward based on what's just happened and what continues to happen, and the productivity levels, you know, the lifestyle, the employee satisfaction's all been increased. So there is an argument that will change the way certain companies work. Then you can talk about the process, you know, AVMs, automated valuations, e-signatures, remote DD from a lawyer's perspective. You know, that may all have an effect, but who knows whether that's here to stay at this point, or whether that's still it's an infant stage of, you know, development. So I think there are a few wires to this conversation, and I think ultimately it will change the way people work. Whether that's immediate or not is left to be seen, I guess.
Ed, do you have anything to add to that?
I've got very little to add, actually. I think Matthew covered most off. What I would say is, from my own personal perspective, I've been incredibly impressed at the ability of work streams to continue and undertake their tasks remotely. You know, from a legal perspective, you know, we've had loans complete with offshore structures over this period, and I've been gobsmacked actually at the efficiency of people's working remotely. I didn't. If you'd asked me prior to this happening whether it would be possible, I wouldn't expect it to be possible in the way it has been. And I think we'd be crazy to think there won't be any learnings from this that will be taken forward into what the new world will be.
I'd just like, so if I was to just add to that, and it goes back to my point where everything seems to have accelerated at an enormously fast rate across the board, and we've certainly seen there was a shift in working practices anyway. More people working from home, more people working remotely, in chill out areas, in co-working offices, and this is only going to accelerate that even more. You know, we had always been interested, not that we've been practice in sort of blockchain technology and how that may be used in real estate to speed up transactions. And you know, I am sure there are groups of people working on that right now, and you know, some may have a view of the law industry, because I know that has been muted, and Michael may have a view on valuation, but you know, we can certainly see those types of technologies fundamentally changing the way and speeding up practices for real estate and real estate finance. In terms of the new working, you know, what gives me great comfort is, you know, before this happened, there was an undersupply of housing in the UK. That is not going to go away. You know, it is yet to be seen people's affordability and can they afford to buy new homes because of unemployment. But fundamentally, houses need to be built. They will be built, and all the people on this webinar are involved in that supply chain or process at some point. So, you know, that is not going to go away. You know, but we may adapt to our practices on how we deliver that.
I'm interested to know, like, also from a lender perspective, Dan, the like how are like BDM? I don't know if you have BDMs in your structure, but how are they working differently, or relationship managers? Like how are they working? Because normally they'd be on the road and visiting brokers, and I've heard from quite a few brokers that they actually like the checking in through Skype or Zoom or whatever they're using, and it actually is becoming more efficient than them traveling across the country.
Yeah, I think that's right. We don't have BDMs in the truest sense of having people roaming the country. We have a nucleus of originators, and they've taken the opportunity. They have a regular meeting, and I do the same. I have a regular meeting with a certain number of individuals or peers just to catch up, and it's quite enjoyable. You know, I can see or speak to 8 people in a 2-hour block on 15 minutes each time, whereas that may take me maybe 3 or 4 days during a week in London, where I can do it in 2 or 3 hours from my office that I've walked up 10 flights of stairs to get to, or 10 steps to get to, and I'm not bedraggled because I've sat on a commuter train. So, you know, it's actually quite nice from that point of view. I don't think there'll ever be a substitute for a direct face-to-face in-person meeting, and I always see the value in that forging relationships. But certainly, this will supplement that. So you may have a direct catch up once a month, once a quarter, and supplement that with video conferencing as a better way to build relationships.
Yeah, I think I'd agree with Dan there. I think, culturally, across all industries, there could be a shift. But in our industry specific, a face-to-face or a site visit or see the whites of somebody's eyes is quite important. And that I expect to be a mainstay of what we work with. But, across the board, industry-wise, I think there could be a huge cultural shift that will entail a different structure and a process that will be implemented via tech. But within what we do, I think the need to see, smell, and kick the tires is going to remain there, and I think that's going to be quite prominent. To
real estate is still a people business.
Yeah, agreed.
And then there's questions for you, Nicolo, more about supply chains. What effect do you think COVID-19 will have on supply chains that, from a developer's perspective, not just in the UK, but also sourcing goods and labour internationally? And how will it affect developers' profits and lenders' loans?
I think you're already seeing that. We have been battling for the last 3 weeks to truly understand the financial stability of our subcontractors. We've already have several that have gone under in a very, very short period of time. It's only a question of time, I think, before major general contractors also might go the same way, which unfortunately then will create an oligopoly, and it's obviously going to increase pricing of construction. On the material side, we've actually seen an incredibly active European market where they've tried to do all they could to deliver the goods throughout this incredible crisis, and so it's on that front I think that we will be relying on goods coming from the rest of Europe more and more going forward.
And I know we briefly brought it up earlier, but does Brexit affect sourcing your materials or labour from Europe, if that's where you're looking at?
We'll have to see what the negotiations come up with, right? At the moment, we just don't know, and it's, I think, some of the guys on the call just saying afterwards, once Corona is over and we actually start digging deep into actually what Brexit would look like, then we'll have a clearer steer. I doubt that we're going to have tariffs or impositions on goods coming from the rest of Europe. The economies are too intertwined.
And obviously, if labour and supply chains are impacted by this, and this will also affect lenders' loans. So Dan, from a lender perspective, how worried are you about this and kind of eating into developers' profits?
Yeah, we are very conscious of this, and as Nicola said, we are seeing this on the sites that we funded. I think we are on over 20 construction sites at the moment. Some have shut down, some are on a real go slow. One of the consistent bits of feedback is getting materials in from Europe because they're not seen as an essential item. So we have to stress test that. So we've done an exercise to go through our existing loan book on stress testing what the delays might look like in terms of loan and where that pushed the risk, and also the cost, because if materials have not been contracted and developers need to source those, or contractors need to source those, that could put pressure on the prices. So there could be price increases on some packages. So we are stress testing both of those. Now, this is obviously focused on what will the world look like post COVID-19. We'll just need to assess the supply chain from labour and construction at that point in view. But certainly, we do a good amount of stress testing in any event. We hope that we can sustain some cost increases and program delays, but this may drag on beyond where stress tests have been undertaken for a majority of lenders, which could put a lot of pressure on loan to values. But I think the approach generally lenders need to have a sensible approach with their developers and their contractors. This is no one could have foreseen this. This is no one's fault. There needs to be an element of pragmatism about this. And I'm just hopeful that across the board people take that sort of sensible approach to working through this together. But we're already seeing some sites return. labour appears to be not necessarily the issue, and I hear different bits of advice. Some sites say they struggle for labour, others don't. A lot of people actually want to get back to work. They want to be able to earn any money. So, you know, the sense I get is it's not really labour; it's probably more supply at the moment.
If I could add to that, it's also very important to try and understand, and no one has the answer to this, is who's going to be picking up the tab for this, right? So government hasn't said that sites need to shut. So voluntarily, a lot of general contractors have actually decided to shut these sites down. Technically, that's in breach of contract, right? Because the government guideline was not to shut them. So I think that there's going to be a mighty old fight on actually who's going to be picking up the tab, and these tabs are very, 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 very big. And that's when I was talking before about, you know, the general contracting landscape and how it's going to look in the months ahead.
Dan, as part of your stress testing, are you looking at, are you assessing the original loan terms versus the new kind of predicted completed project dates once sites are fully mobilised, and will you be offering loan extensions as part of that?
I think each one is a case by case. There was always a benchmark against what the underwriting position was. Ultimately, generally lenders lend against a percentage of end value, a percentage of total cost. You know, those form part of the credit decision. Those are generally embedded in loan docs as covenants. So yeah, there always needs to be a reference to that. You know, and we will have to assess what the scenario testing does. But you know, on one level, you know, if contractors are not employing labour or spending money on materials, then the funding isn't going out, so there's less interest being rolled up. So it's not just simply a case of saying it's been delayed by 6 months, so let's add 6 months interest onto a fully drawn loan balance, because that's not the case. You know, you have to reflect reality, and there are a multitude of factors going in. So when you do start stress testing, the impact is probably less than people may fear in the first instance. I think is what a lot of people who have seen these sort of downturns before will understand that yeah, there's an immediate, oh my God, you know, this is a disaster, my loan to value is going to go over 100%, but actually in reality it may not necessarily do that, because you know, the big factor here, and Michael could come onto this, is the construction costs being funded and the program delay are definitely one to be conscious of. But you know, if there is a 20% downward shift in end values, that's going to have a far greater stress on the loans than a 5% increase in costs and a 3-month increase in on a 36-month program. You know, it is the exit values that will put more pressure on the loan covenants than the delivery of the projects.
And then